Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. And today we're going to get into part 2 of option trading, top 10 mistakes to avoid. We're going to look at mistakes 6 through 10. We've already done part 1, and you can go back and look in the archives and you can watch that. That was a more basic top 10 mistakes, if you will, talking about mistakes that a lot of beginning option traders make. And today we're going to get a little bit more detail. We're going to go a little bit into the minutia of the mistakes that we see. So this is a little bit more advanced, and you definitely want to watch part 1 if you are a beginning option trader. So we're going to jump right into it. And the very first, or number 6 mistake that we're going to look at, and it's a fairly important mistake that I see happen a lot, is waiting too long to buy back short options. So in the options trading world, we talked in part 1 a lot about buying options, buying a call because you're bullish, buying a put because you're bearish. Now, on the other side of the coin, you can sell options without owning them. It's very easy to sell an option contract without owning it. Most of the time that people are doing that is they're doing spreads, in that they're selling a short call spread, they're selling a short put spread. But bottom line is that when you sell option contracts, you take on an obligation. And if it's a call option, it's going to be an obligation to have the stock called away from you. And if it's a put option, it's going to be take on an obligation to have the stock put to you. So if you're short option contracts in a spread, or just in general short an option contract, you have that obligation. And now if you're selling something and you're bringing in a premium, a lot of times in the options trading world, that last smidgen of premium is really hard to extract out of that option contract. Now, in the theoretical world, it doesn't quite feel that way, but in the real world, that's a very true scenario. So here's my attitude on trading options. First of all, let's look at the mistakes. Always be ready to buy back short options early. Don't always think to yourself, well, I don't want to pay the fees to get out. I don't want to do this. It's almost always worth it, especially if you have a gain on a position, to take as much of the premium as you have. In other words, you've sold to open the spread, you've sold to open this option contract, and now you want to unwind it. You want to close that position. And if you, on a one-off basis, it's probably not going to hurt you every once in a while when you do it, but over a career, you'll be surprised how often you will get a snapback in the underlying stock, and that will bite you because you didn't close it when you had the opportunity to pay a small amount of premium to do so, or price of the option contract, if you will. Okay, so if I go and I look at this, how can I trade smarter? Well, I put numbers on it, and you can decide what that number is for you. But if you can keep 80% or more of your initial gain from the sale of the option contract, consider buying it back. So to put numbers to it, if I sell a spread where I'm bringing in a net credit to the account, so I'll call it a credit spread, and I bring in $1, if I can buy it back for 20 cents, I want to close it. If I bring in $2 and I can buy it back for 40 cents, I'm going to think hard about closing it. And you can decide if you want to make that 90%. I'm somewhere in between 80 and 90%. It all depends on how I feel a little bit about the stock. But here's my point, is once it gets down to the point that you've captured almost 80% of that net premium that you received when you did your strategy or sold your option contract, think very hard about closing it. It's just that simple. Don't be scared to close it. Don't try to wring out all the water that's in that washcloth. Just go ahead, move on to your next trade, and most of the time you're going to be happy that you did that, as opposed to getting that whiplashed on the underlying stock, and all of a sudden, before you know it, that nice little gain that you have has gone away, and now you're losing money on the position. So this is just a very simple rule of thumb, that if you see your short option positions and you bring in the bulk of the premium, consider closing, without a doubt. Okay. Last thing, how to trade smarter. Well, 80%. I'm just going to highlight the other things. Waiting too long to buy back a closed short option to make a few more pennies is usually not worth the risk reward. I kind of think of it this way too, in that let's say I sold an option or I sold a spread for $1. I sold a credit spread for $1, and it's trading for 20 cents. I think to myself, when I see it at 20 cents, gosh, would I have sold this position for 20 cents? Like, do I want to double up now? The answer is no, I don't want to do that. It's not enough premium. So this is the time to close it. That's simple. If you think of it in reverse, I'm down to this. I'm going to try to extract that last 20 cents out of the marketplace. A lot of times it's just not worth the risk to try to get 20 cents. That simple. All right. Mistake 7, failure to factor in upcoming events. Oh, I see this all the time. The one big known event, right? Earnings season. Trading during earnings season typically results in increased volatility for stock and options, and usually prices will be inflated. So people will look at prices, and it's very simple. If you've been trading for a while, you'll hear that technical term, and I say that jokingly, where there's a lot of juice in these option contracts. Well, if there's a lot of juice or something seems a little bit out of whack, that probably is a reason. So you should look for that reason. And a lot of times the most common one is that they have earnings coming up. So you want to be aware when you're trading options, understanding that, first of all, options they come from the insurance marketplace. There's a lot of synergies from the way that they're priced, the vernacular that is used. And so if you are thinking about trading options around a known event, like an earnings announcement, it's kind of like, trying to buy homeowners insurance when you're in Florida and they've already announced that a hurricane is on the way, right? That insurance is going to be almost impossible to get, or you're going to pay an extreme premium for that. So with all that said, be aware. It's very simple that if you look at something and it looks too good to be true, or it seems to be a little bit out of whack, look out and see when the next earnings event is, or maybe there's a major announcement about a buyout or a merger or an acquisition. Something is probably going on with the stock, because it will always be priced into those option contracts. Does it matter if a stock pays a dividend? Yeah, it does. Guess what happens when a stock pays a dividend? Stock goes down by the amount of the dividend. So if you own call options, that's not good. If you own put options, that is good. So yes, option prices are affected by dividends. It's usually a known event, and you just want to be aware of it. And it's a little bit more important when you're short option contracts than when you're long. If you own a call and the stock goes down, the dividend's already priced in. So first of all, be aware of what happens when a dividend gets paid. The stock does go down, but it's considered unchanged, even though it went down, because it was a known event. It was a dividend. So pay attention to dividends. The one thing that's easy to look up, pay attention to earnings, because that's always announced too. And then also, you just want to be aware, if you're going to be trading options, just around other possible news events that could happen. So check the news. That's simple. All right, trade smarter. Factor in upcoming events such as earnings. Avoid higher risks. Just simply do it. That's simple. Consider using spreads to manage risk effectively. If you want to trade around earnings, think about spreads, and that's going to be one of the mistakes here that we'll talk about. We'll get into a little bit more about what a spread is and what it means to trade a spread and when you want to. All right. Ex-dividend dates are the dates that you care about, as far as there's payable dates, there's announcement dates on dividends, and everything that goes along with it. But the X date is the date when the stock actually changes. So that's the date that you want to know, especially if you're trading option contracts. And that does have something to do with exercise and assignment, which we're going to talk about here in just a second. All right. Mistake 8, not being open to learning new strategies. A lot of people just want to buy a call, just want to buy a put. They don't want to look at something that's a little bit more esoteric, and they get a little nervous about that. But if you're trading around earnings, you have to learn about long call spreads. You have to look at short call spreads if you want to sell option contracts. If this is one of the strategies that you like, you try to collect premium. I'm going to show you these inside my options playbook when we get to the very end of the presentation. But open your mind, expand. If you're only going to trade buying calls and buying puts, well, first of all, you're going to have to learn a lot about the option pricing, and that's what we talked about in part 1 of the top 10 mistakes. Mistakes 1 through 5 is all about buying option contracts in general. But open your mind. there's a lot that, in the options trading world, the flexibility is probably the most unique thing about trading options in general. You have a forecast, you can target your forecast based and fit your strategy to fit your forecast almost perfectly, right? And then if your forecast is correct, hopefully you'll get rewarded. But that's simple, that's straightforward. So here's an example, how to trade smarter. Think about spreads and how they differ from simply buying options. One of the biggest thing about a spread is, say you buy a call, let's say the stock's trading around 50, okay? And we buy the 50 strike call. We'll go out, we'll say 2 weeks, 14 days. And so we buy this 50 strike call. Well, over the next 14 days, do you really think it's going to go beyond 55? That's 5 points. That's a 10% move. Well, if you're targeting that the stock will get to 55, well, think about selling the call against it. Bring in some premium, reduce your risk, change the dynamic of the trade. You're selling an option contract that wants time to go away, that likes time decay, and you're buying an option contract that doesn't like time decay, that's struggling with it. So they kind of help offset each other. And if you're going to get out anyways, if it gets above 55, why not think about just doing the long call spread? There's a time and a place to just buy a call. But if you're thinking about doing a target, or you've looked at it, you've looked at the chart and you see this is the trading channel that it's in, I don't think it's going to break above this level. Maybe this is the time that you want to think about or explore doing long call spreads if you're bullish, or long put spreads if you're bearish. And we're going to show you those inside the options playbook here in just a second too. All right, so we're already to mistake number 9. Now this goes hand in hand with the dividend conversation that we had, but mistake number 9 is not understanding the concept of early assignment and when you do get assigned or don't get assigned on option trading. Now, if you sell an option contract, you get premium. For that premium, you take on an obligation. You don't decide if you want to be assigned or not. The person that bought the option contract, or a person that is long an option contract, decides if they want to exercise or not. And this is odd, but a lot of people don't know this, but the numbers have been solid from the Options Clearing Corporation going all the way back to 1973. About 10% of the time, people actually exercise their option contracts. Most of the time, options get closed on the marketplace. About 70% of the time, they actually get closed on the marketplace. And that means that about 20% of the time, you're going to see option contracts expire worthless. So the numbers are as this. Most of the time, option contracts get closed. You buy to open, you sell to close. You sell to open, you buy to close. Only about 10% of the time they get exercised. And about 20% of the time, they actually expire worthless, which is a good thing if you're selling option contracts, right? That we talked about here a little bit earlier. So the dividend, if I'm thinking about exercising a call option, sometimes if a stock is paying a big dividend, people will exercise and buy the stock if they planned on owning it to get access to the dividend. You exercise, you own the stock, the dividend gets paid, the stock goes down by the amount of the dividend, you get that dividend in your account and you move on with it. That's a very feasible way to do this as far as option trading is concerned and how dividends work. Now, if that concept is a little bit confusing, don't worry, I got some homework. I'm going to show you a nice article that really summarizes this and puts it all together inside optionsplaybook.com, which is where my website is, which is the URL to my website. How to trade smarter. Understand this. Just understand what could happen. It doesn't happen that often. And it's really quite simple why it doesn't happen that often. And that if you buy a call option, you have the right to buy the stock at a specified price for a specified time period, right? If you exercise your right, what do you do with cash? You spend it. You have to spend it to be able to buy that stock at that strike price. All right. Now, do you want to spend cash now or do you want to spend cash later? I'd rather spend cash later, right? So I know what price I'm buying it at, and the stock can go down. So if the stock actually gets in the money on my call option and I want to get out, I'm probably just going to sell it. Why do I want to exercise and own the stock and have all the risk of owning the stock and I have to spend all that cash to own the stock? Now, on the other side of the coin, if you're talking about put options, dynamic's a little bit different. So I own a put option. You got to think about, I'm selling it. What are the odds of me getting assigned early on it? Well, they're a little bit higher with a put. Why? Because if the owner of a put option actually might own the stock and just wants to get out, well, if they exercise now, they get cash now, as opposed to exercising later where they get cash later. Some people might say, I want the cash now. So if you're selling put options, the odds of getting assigned early are a little bit higher, only because of that dynamic. But once again, only 10% of all option contracts usually get exercised or assigned. Most of the time, it behooves you that if you buy a put option and the market goes down, to go out and sell it and try to capture as much of the time premium as you can and get out of the position. Go into more detail inside the options playbook, and I'll show you that in just a second here. And then we get to mistake number 10. People are scared of index options. I love trading index options personally, especially if you're looking to sell option contracts. There's a couple of dynamics. There's some tax benefits actually to index options. I don't want to get into that because I'm not a consultant. You need to kind of look that up, but there's something called the 60-40 rule that you might want to look into. Once again, I'll say that 60-40 rule that you might want to look into. So if you are thinking about trading short strategies and in particular shorter time frames, 15, 20, 30 days out, think about index options and trading them, and don't be scared to learn about them and apply some of your strategies. You can look at ETFs that trade on indexes, but they don't have the same dynamics as index options do, like the feature called cash settlement, where you exercise an index option and it's in the S&P 500 index. You don't get all 500 of the stocks. All that happens in that scenario is that the difference between where the index is at and your strike price becomes cash. And all of a sudden there's cash in your account where there used to not be cash. That's simple. So that's called cash settled. So how to trade smarter. One of the things that I like about index options, and I'm going to highlight it here on my slide here, is you reduce yourself to big swings. I use this term lightly here in that we use some volatility and some predictability, right? Some volatility, some predictability. It's an oxymoron in general. But if you think about that, you don't have some volatility and some predictability on a stock because you get the gap openings. And that's one of the biggest things that scares you the most is gap openings when you are selling option contracts. And in the index, that is greatly reduced. All right. So with all that said, my name is Brian Overby. You can follow me on x.com. My handle is @BrianOverby. Check out the Tradier website and thank them for sponsoring all these events. The one place that you want to go if you want to check out more of the great speakers and content is hub.tradier.com, hub.tradier.com. Take the time to fill out a profile. It's free. You get access to everything. You can ask questions of the speaker when they talk live inside of the hub. And now we're going to go to my book, optionsplaybook.com, and I'm going to give you some required reading if you're worried about these top 10 mistakes, give you a little bit more fodder to go along with this presentation today. And if you have questions during the live events, if you go to hub.tradier.com, you can ask them. We also stream live through x.com, through my handle, and also through Tradier's. And there isn't the availability to be able to do it through the Tradier YouTube platform also. All right, so we're going to back out a little bit here, and we're going to go to the website. All right, 1 second here. All right, so let's show optionsplaybook.com. This is a book that I have authored. It makes a great holiday gift, considering we're doing this over the holidays. All you got to do is click buy the book and check it out. But if you're interested in long spreads, the very next step from outright buying of calls and outright buying of puts is to look at long spreads, otherwise known as debit spreads, otherwise known as bull call spreads, bull put spreads. You're paying a net debit and you have a position. You're buying the stock with the stock somewhere around strike A or maybe even between or a little bit below. You're buying strike A and you're selling strike B, your target price where you think the stock can get to. And you're selling that, bringing in premium, reducing your risk. So read more about that there. Like I said, early exercise. If you want to find these little things, you can go to the resources tab and look in the option basics, and you can find it there. or quite simply just type in exercise into the search box and this will come up. So you can actually find it via the search box if you have one of the words that's in the title. That's straightforward. And then this is more detail on index options. If you just type in index options into the search box, it will come up. So, all right, let's close it up here. My name is Brian Overby, known as the options guy inside the Tradier Hub. We do the show every Monday, Wednesday, and Friday at 11 a.m. Eastern time. Please sign up for the hub, hub.tradier.com. Put in a profile. You can ask questions during the show. We want to make it a very interactive show. Please share this with friends and family. When we get into the new year, we want to learn a little bit about these option trading mistakes. If you want to ask me some questions, please do so when we're live inside the hub. So with all that said, once again, Brian Overby, handle on x.com is at Brian Overby, author of the Options Playbook. Hopefully we'll see you in the new year on the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.